SCHD has an 8% dividend yield? What? All right, so I got an email from my man Bradley. Good guy. He's doing tax planning. He talked to his accountant. And I can't remember if he's doing I can't remember what he's exactly doing, long term or I forgot. But he basically said he's going to put 150,000 SCHD, and he's trying to keep within the 12% tax bracket so he can pay no taxes on his long-term capital gains and qualified dividends, which is good planning, 100%. It's a good move. But he said he's going to put 150,000 SCHD, and he figures he can generate $1,000 a month, $12,000 a year. $12,000 a year on a $150,000 investment, that's an 8% dividend yield. I say, whoa, where you get that, big guy? He said, from Portfolio Visualizer. I said, no, don't use back testing to get you future projections. No, especially when it comes to dividends and capital gains, especially capital gains. Dividends are pretty easy to do. You say, what's my dividend yield? That's it. I mean, dividend yield today is now this is for new investment going into SCHD. The dividend yield today is for new investment. You put $150,000 in there, you're probably getting roughly a 3% dividend yield. I don't know, but we'll just say 3%. That's $4,500. That's a pretty good starting point to do tax planning for the next year, 100%. Do not use Portfolio Visualizer. Do not use past projections or past performance on dividends, in particular capital gains, especially for sure, because they're meaningless going forward. Take that out. And only do it for this year. You don't do it for next year. Now, I get what he's trying to accomplish. It's like, look, if I dump 150,000 SCHD, I should generate X amount of dollars a year. X amount of dollars a year would keep me in the 12% tax bracket, essentially in perpetuity, and I won't pay taxes on those dividends, long-term capital gains. I get what he's trying to do. But the thing that we have to contend with is long-term projections on past, and we all know this is, you can't do that, especially when it comes to dividends, especially capital gains. We have no clue what the capital gains are going to be. So what you do is you say, okay, for next year, these are my projections. I dump 150,000 SCHD, I'll get $4,500 of income from dividends. I might get a little bit of capital gains too. I don't know what it'll be, but let's just say 5% capital gains. That'll give me $10,000 a year of income. As long as I stay within the 12% tax bracket, I don't pay any capital, I don't pay any income tax on either of those gains, dividends and or capital gains. If you do it for more than next year, though, projecting, don't make, that's a mistake. And the reason is because you have no clue. We have no clue what the capital gains are going to be, if there are any. We got no clue what the dividends are going to be, income, if there is any. We just don't know. You got to do it annually, once a year. And I mean, look, and again, that's pretty much, I think, what he's doing. He's trying to annualize it. But I get people all the time like, how much should I convert in 2037? I'm like, dude, I have no clue, man. I expect to get X amount of income in 2037 off my portfolio when I don't have to touch the principal. Like, you don't know that. That's all speculative. You have no clue. And you're like, well, I got to plan someplace. Yeah, long-term projections are fine. But what we're really after from tax planning perspective is year over year. Year over year. And so for me, your old buddy Josh, VTI, all right, VDIGX, and VWELX. That's it. VTI is in my brokerage account. VDIGX is the Vanguard, their version of the SCHD, I think, is in my Roth, and Wellington is in my IRA. All right, so I say at the end of the day, I'll have to take X amount of dollars from my IRA, say $15,000 a year for RMDs, just use that for an example. I'm only 51, so I'm just using this for example. That'll be taxable, $15,000 taxable as ordinary income. I'll have $45,000 Social Security. That'll be $60,000. My tax bill would be nothing. It would be nothing. The rest of the money would be in Roth, which I don't really intend to touch. If I do, it's all tax-free anyway. And then my VTI is my total stock ETF, total stock fund ETF, and that will yield off, maybe 2% dividend if I'm lucky, and capital gains, which are not taxed simply because it's an ETF. And as such, I'll make whatever income I make will be tax-free to me. All right, and that's the way I look at it for sure. And that's the way you should look at it too. And that's what my man Bradley's trying to do. He's trying to calculate this of 100%. But you can't use past projections on dividends and capital gains. Have I said that yet? I think I have 1,000 times. To forecast future, you just can't, because the dividend yield, and by the way, it's yield to cost too. So not the current dividend yield. So if you got $100,000, if you're going to put $150,000 in SCHD right now, your dividend yield matters. If you put 150,000 in SCHD 10 years ago, the current dividend yield doesn't matter because you're not buying the shares right now. Your dividend yield is what your cost was. 150,000 bucks is what you put in, and what you are getting as an actual dividend payout relative to your 150,000 is yield to cost is what that matters. So don't pay attention to the current dividend yield on holdings that you've had, you already own. It is meaningless, frankly. I'll have to do another video on that. But I hope this makes sense. Be careful of tax planning. And I get this a lot too. Like I expect, I'll have 100,000, million bucks, whatever it is, and I'm gonna get all my dividends and capital gain I'll spend. And I won't ever touch my principal for the rest of my life. But you don't know what it's gonna be, man. You have no clue. Because if you look historically, there's some years there are no capital gains. Just none, and the dividend yield isn't enough to keep up hell with inflation. And don't forget, the old dividend yields were 4 to 5% in the old days. Nowhere near that. It's never come back. I mean, it could come back from a dividend yield. The only reason that would happen, though, is the price of the shares drop, which means your capital gains that you're assuming will go down. This is too fluid. Capital gains and dividends are too fluid to plan for long term. You just got to do it on an annual basis. All right. Love to hear your thoughts. We'll see you.